welcome everybody this evening. Strata Ventures brings every week key speakers, and we're very fortunate to have Jason Jimenez of IMD Insurance and Financial Services to talk to us today about a very interesting topic. I don't think we've ever had this topic in any of our forums, Jason, so I think we're all going to be all ears to learn and to learn a little bit more about you. So there's a couple housekeeping things that we go over here on the webinar, so bear with us just a bit. So we're starting promptly right now around 6:30, 6:33. Around 6:35, we're going to go ahead and pass the ball over to you, Jason. And around 7:10, 7:15, but you can control that time, we'll open it up to a group Q&A. With everybody that's joining us, know that in your Zoom windows, there are some key buttons that we'd like for you guys to use if it does come to a point of live speaking. There's a mute button. We also have a video to activate or deactivate on there. And please, if you have any questions, please make sure that your questions are being asked in the Q&A section of the webinar. There's a little button right down there at the bottom. It says Q&A. Please input your questions there. And if you wanted to send some direct private chats to the moderator, that would be Enid Lopez. She'll be happy to answer those questions for you. And again, like I always say at the end of the night or during the webinar, if we're boring you to death, there's always the leave button, right? You can always hit end. But we do encourage questions, guys. The more we can stimulate the speaker, the more information they're going to have for us. This is a perfect time to take advantage of all of your information, Jason, and to give us basically why we're here, right? Is to get great information and to learn from you. A little bit more about you, with SVI, is if you guys are wanting to know a little bit more about Strata Ventures and you'd like to log in or register for a free one-on-one training session with us, go to www.investorrealestatetraining.com. Take a look at that landing page. There's a lot of great videos and information, and we look forward to hearing from every person that's new. I know we've got a lot of already existing Strata Ventures members there that come to these webinars, but if you're new and want to know more information about us, please feel free to chime in at the investorrealestatetraining.com landing page. So I almost had to go 2 pages on the key points on the key speaker points here, Jason. I've never had to do that before. So let's go ahead and here. I'm gonna chime in on a little bit, or if you want to, I put a couple key points here of things that are part of your bio and resume. If you want to just talk about them and quickly say a little bit about them, and then we can move on to your presentation. So sure. Feel free. Welcome, Jason, and it's a pleasure having you, sir.
No, it's an honor, J.O. and Strata Ventures. I'm grateful to be part of the presentation today. And a little bit about me. So I've been in the insurance industry since I was pretty much a diaper. I've been in the business since I was 15. Started running and operating my father's company since he opened it up in 1982. When I was about 19, about the age of 20, I was already running and operating his business. And then my mother basically asked me, hey, why don't you try this yourself? And she basically said, you should do this. And I said, I don't know if I can do it. And she said something that really defined the rest of my life and how I perceived it. And she said, what the hell do you have to lose? Well, 21-year-old had money in the bank, but I knew the business. But I really looked at it from a perspective, really, I didn't have anything to lose. And that's how I started my business, my first company at the age of 21. I've been very fortunate, a lot of luck, but yet really be consistent. And fortunately enough, throughout the years, I've been able to build and create and develop companies. I've been able to invest in them, somewhat in the areas of real estate, into industrial, as well as the areas of tech. And today, I'm very proud to say that if somebody asks me what I do for a living, it's pretty much I protect people's shelter, their transportation, their business, their life, and more importantly, right now, the hot topic is their identity with cyber threats in today's world. And so through that, I've been fortunate enough to be able to build certain things. And through that, there's a company that we have, it's called Redstone Business Holdings, which is a capital consulting firm. So very much in the realm of investing in businesses, seeing an ROI, but also really filling in the holes when they're identified. We have 2 holding companies. It's a JJ Innovation Holdings, which is in the insurance realm, which is property, casualty, and financial services. And we also have the Redstone, which is a capital consulting group. One of the really the things that I would say that I'm very proud of is in 2014, I was named by the Houston Business Journal. I was one of the top CEOs of the city of Houston. And then just recently in June of 2020, our insurance firm was named in the top 3 insurance agencies in the city of Houston by the Houston Chronicle. And those are the 2 accolades that I was very proud of. And in 2012, we were named by the National Republican Committee through the legislation as being the Businessman of the Year. I say that to not depress anybody, but I say it mainly just to impress upon the fact that I love what I do. I believe that we were here to be of service, and I try to do that in everything that I'm really involved in.
Excellent. Good. And I've known you for quite a while also, and I'm very fortunate to be your friend, and also to know that, you know, you have services there that can definitely be a benefit to a lot of our people that are attending in these webinars. So with that, what I'm going to go ahead and do, Jason, here is talk about the key points, right? These are going to be the key points of what you're going to be speaking about this evening. We've got protecting your investments as you build your portfolio, the difference between purchasing under your name versus an entity, what insurance do you need when buying into real estate investments, and becoming your own bank with life insurance and why. Am I correct on those key points that we'll cover today?
Yes, sir.
All right. So with that, let me go ahead and I'm going to now pass this along to you, sir. So feel free to go ahead and share.
Okay.
And everybody that's watching and listening, don't hesitate to ask your questions in the Q&A section of your Zoom bar. We will get to those as soon as we get to the Q&A section, or if there's one there that I think might be good for you to answer, Jason, I'll just kind of chime in on that if that's all right with you.
Absolutely. Yeah.
All right.
Can you see the screen?
Yep, absolutely. We're looking at light blue colors with dots and circles with words in them, correct? Okay.
Yes, sir. Well, again, I really appreciate you having me here. And my goal for today is for you to understand that I've been down the road of being an investor, being scared, being excited, failing, being able to go and really get into this. But what I've taken in the knowledge and being able to build it out, because part of my role and responsibility is to protecting the assets of the people that I represent from an insurance perspective. And that being said, our topic for today is protecting, mitigating, and being able to be your own bank and utilizing insurance to do so. And you may ask the question as well, how does that really work? Well, I'm going to take you down this road of being a real estate investor, because one of the first things that you want to be able to do as a real estate investor, and Diego has stated this even when I first started talking to him about the company, is understanding risk. And by understanding risk, you have to also be able to understand you have to protect it. Well, the first thing it starts with is protecting the things that you love. Well, to me, maybe my family, or maybe your family, or maybe the entity that you've created and the roadmap that you want to be able to do. And so to start off with, you want to be able to understand is when you're actually purchasing real estate and you're going into your first transaction, you've got to understand you are legitimately going into business. Just because you buy a property under your name, you're technically considered as a sole proprietor. Now, if you go and engage in a election attorney and creating an LLC, one of the questions you want to be able to ask is, well, is there a difference if I get sued? And the reality is there is. If you are a sole proprietor, you have to take into consideration, and disclosure, I'm not an attorney, but it's one of those things that you want to be able to advise from an attorney. But I will tell you that as you let yourself exposed to everything that you've worked very hard to build, because one of the things that you need to be aware of is somebody happens to get injured and in suing you, and by buying it under your name, you're automatically giving them access to your personal things, your retirement, your savings, your IRAs, things that at the end of the day people can grab a hold of, including and not limiting to the actual asset that you've purchased. And so the following question is, well, what type of insurance should I buy? Well, it doesn't matter if you purchase the property under your name, or if you purchase it under LLC. There's still solutions on either way. Highly recommend that you create the LLC. There's a separation between you as an individual as well as from you as the entity. And so the typical insurance that we provide to all of the investors we work with is what's considered a general liability, which is technically a actual policy that we would give you for and against lawsuits from if your business did something that was deemed as liable to a third party. And last but not least, well, the question may be is, well, how much do I really need? Well, the answer is it depends upon you. Every person's in a different scenario. You might be getting into real estate very early on, but you have no assets to support it, and you're able to leverage hard money or third-party money to be able to get into the business with little or no money down, as you always hear throughout these webinars and scenarios. Or you may be an individual that's seasoned that actually is using disposable money to get into real estate, but you have assets that you've built over time. You have family, you have retirement, you have college educations you want to protect. So the reality is that it really just depends on the person. But if you're starting out in real estate, a general liability policy, that what I would recommend to start with is about $1 million in coverage in general liability. And from that general liability policy, it probably ranges somewhere between $500 to about $1,000 a year, which is relatively inexpensive, but very, very valuable for you to be able to deal with and to work with. The second thing is you want to be able to understand is ensuring the investment with confidence. When you're going into a real estate investment, one of the biggest things that you need to be aware of is when you buy the asset, you've got to be able, in most cases, doesn't matter if you're going to rent and hold or if you're going to flip it, there's some form of renovation that comes into play. Well, you now have the liability of dealing with that. And so the first thing you want to deal with is what's considered the builder's risk insurance policy. Now, what is builder's risk? Well, you're talking about a policy that is completely focused on making sure that during the renovation period of your purchase of the investment, you are insuring not only the structure, but the materials that you actually are purchasing to be able to rebuild or renovate that particular property. But, and I say but because of the fact that if you look at this area that's highlighted in white, it says, because every construction project is unique and each builder's risk is different, it is based upon the type of project that you get involved that's going to determine exactly how we want to be able to structure that. But nevertheless, you have the ability to have the coverage of fire, lightning, hail, explosions, theft, vandalism, and even act of God, so hurricanes and things like natural disasters. Now, when you're dealing with builder's risk, you also have the ability in certain cases, because there's a necessity, to cover materials, supplies, equipment on site, and even in transit, or if you have the equipment at other locations, as long as it's deemed specific for that job that you have. Now, you may come to me and say, you know what, this project renovation is going to be 2 weeks. Well, then we'll do a policy for 2 weeks, and they will last. If you happen to extend that for another week, it's just a matter of upping the coverage for an additional week for the premium amount that would incur. From that, what does the builder's risk cover? Well, some of the things and some of the benefits here as a state is going to cover lost sales, rental income, additional interest in loans, real estate taxes. Some of those things are very vital when you're dealing with real estate, because it really boils down, time is money. The faster you get in, the faster you get out, as long as you do quality work, the output of what you end up getting as an ROI ends up truly benefiting you. So some of the other things that you want to be aware of is scaffolding, construction forms, temporary structures, debris removal for certain events, and even some of the cleanup is also covered within areas of builder's risk. Well, what happens when you end up completing your actual renovation? You then turn and you convert that builder's risk into what's considered a permanent policy, and there's something called a TDP. Now, if you notice, there's a version 1, 2, and 3, and the red is the one that's highlighted. We're going to focus on the TDP3 specifically because that's the one that we typically work with certain investors. But again, it depends on the scenario, depends on the project, depends upon the necessities of the project, which we'll recommend properly. But a TDP stands for Texas Dwelling Policy Form 1, 2, or 3, and that's what basically it indicates in this particular area here. And the reason why we focus on the areas of the 3 is because it's what's considered a broad form, which means the coverage capacity of what you're insuring is a lot more broader. It's not as specific as the others. Number one issue, and the number one thing that I always tell every investor, is the area of making sure that you include what's considered loss of income coverage. If you end up insuring the property and a natural disaster comes and destroys the home or puts it in a situation where the home is not livable, either because of the police department, or the fire department, or simply because the tenants by the lease agreement indicate that it is not livable, technically they have the right to be able to leave because it's not safe. Well, this particular section of the policy creates the ability for you to get rental reimbursement while the insurance company gives you the money to repair the damages that it has incurred, up to 180 days, and depending upon the severity, could be even longer. That is super, super important. So this is one of the main reasons why we consider the TDP3 is to be one of the valuable products that you want to have within your dwelling policy. The other part is being able to make sure that you have the proper liability coverage. When you hear the word liability, think of lawsuits. It's protecting you from those capacities. And you want to be able to max that out and at all possible. And typically it's about a $500,000 coverage on that. And that's, again, covering anybody that is under the entity, protecting against third parties if they get injured and or hurt on property on site. It does not mean that they have to go inside the home. One of the things that you'll be hearing from me quite often is going to be the word umbrella. Well, the reality is, at what point in time should I get it? And we'll get into that a little bit later, but just be aware that the umbrella coverages is going to be super important as you build up your portfolio, because $500,000, if you get sued for 600 and you lose, well, that $100,000 has to come from somewhere. Well, they're good. If a good attorney is really there, they're going to have the access and ability to go and search for other things, and even from a personal perspective. The additional insured section of the policy is one of those things to where anybody who has genuine interest in the property, it could be the lender, it could be a partner, it could be a third party, could be added as additional insured, and you have the ability to make sure that they have access to that simply because the contractor or the contract deems it as to be needed. Last but not least, on the TDP1 policies, you want to be aware that if you're an investor, there is going to be a time when you have a vacancy of that property. If you do not inform the insurance carrier that the property is vacant, and an inspection is done by the carrier, and they notice that the property is vacant, they have the ability to request for a non-renewal or a notice of cancellation of the policy. The reason being is because it's not properly insured. And because by having a vacancy clause, it limits the amount of coverage, specifically fire and natural disasters on the property, but it takes away some of the other coverages because there's nobody living there. It's not a necessity. And the risk ends up being going up and down. So TDP1 is a vital part of what you end up doing.
And Jason, we got a question here about the TDP3 before you go into that.
Yeah.
Myra Mallet asks, how do you tell if you have TDP3 with current policies? Is it listed on the rider, or how would I be able to identify that?
Great question. So first of all, when you get your insurance policy, it's called a deck page, which is a declaration page. It gives you the information of the carrier, your insurance agency, and it'll tell you there, Texas dwelling policy form, whatever, 1, 2, or 3. It'll indicate it at the top, usually at the top of the first page.
Excellent. Thank you.
You don't know, by all means, you can email me and I'll tell you. But you're not done. Just because you've insured the structure of your home and you're insuring the structure against natural disasters and the things that you ultimately care about, because it is an asset, it is what generates you money, most people don't take into consideration renter's insurance. And there's a reason why. Think about it the first time if you ever rented an apartment. It is part of your contract to stipulate that you have to have renter's insurance in the policy. But as an investor, why is it important for you to actually request that you have renter's insurance and that you force it upon your tenants to do so? All of the things, all of the items in white are the areas of things that are covered on your renter's insurance policy. But the one that I care about for my investors and my clients is what's considered a personal liability. Again, liability against lawsuits. The person you have vetted or that someone has vetted for you to rent your property, if they do something on the property where somebody dies, gets injured, creates a liability factor, it is ultimately going to be their responsibility. Any sound and quality attorney will find out easily through the HR, through the Houston HCAD, HCAT,
The appraisal district?
There you go. Thank you, sir. The appraisal district will find out simply that that property isn't owned by them. And if they find out that there's an entity or an individual that owns the property, it's typically an indicator that that property is there's a landlord there. There's nothing that stops them from adding you into that lawsuit. So the reason why we highly recommend to force the renter's insurance to apply is because in that renter's insurance, you can request that the personal liability be maxed out at $500,000, which means first dollars in comes in from the policy of the person who actually caused the liability. Your general liability, which is what we already talked about, could stick in for the other $500,000 so that it protects your scenario. If for whatever reason it exceeds into that, that's only when the umbrella would come into play. But this is a way to be able to mitigate that risk. Make sense?
Yep, absolutely. And Jason, somebody asked here, are your services only covered in the state of Texas, or is it national? Since we now have a national presence,
Yeah.
we are capturing audience nationwide. So Ivan, thank you so much for asking that question.
Yeah, absolutely. No, we actually are established. We're established in Houston, Texas, but we have contracts and licenses in about 5 individual states. When we have the necessity or need to go to another state, it takes me literally about 7 to 10 days to get up and running in that individual state. But currently right now we're in California, Arizona, Colorado, Texas, Florida, and we're just now got Mississippi and Missouri are in the process right now.
Great.
All right. So now we're talking about mitigating the risk. So mitigating your risk is probably one of the things that every entrepreneur or every investor does every day. And so in doing this, one of the things that I put together in this particular presentation are probably some of the top 10 things that you need to be aware of as a landlord to avoid any potential liability claims. Number one, I feel like David Letterman at this moment, but it's at the bottom line. These are the 10 things that you really need to be worried about. Number one is to properly insure and maintain sufficient insurance all the time. Again, as you build your portfolio, you have to take into consideration your business has a direct correlation to your personal assets. So your ability to make sure that you have proper liability insurance is one thing. It is highly recommended to get an umbrella insurance because you can get it between $5 million or even higher. And an umbrella policy ranges somewhere between $300 to maybe $500 on an annual basis, but it gives you $500,000 of coverage. And if you think about an umbrella, it's like it covers you against rain, but everything that's underneath it stays dry. So imagine having your home, your auto, your personal, your boat, your RV, all under everything there, that if any of those causes a liability, their insurance policies will cover you for the expenses. Anything that is in excess of that, your umbrella policy kicks in. Number two, it says make sure that your property is safe and in good condition. Well, as I stated here in the white section. Sorry, I'm going to move this so I can see this. It says also to be sure to regularly inspect the property and to inform the tenants. It is vital for you to periodically just do a spot check because of the fact that this is your property. No one's going to take care of it like you do. And I can tell you that after 20 years in business, I have almost seen it all. And there's always some excuse, and it's something I'd highly recommend. Number three is to remove environmental hazards. You may treat your home the way you treat it, but doesn't necessarily mean that others do. Sometimes we have seen things of very hazardous material on properties, and all of that could be deemed as a liability. And one of the things that the insurance policies will not cover is ignorance and or negligence. It will completely avoid and or deny claims. Number four, keep the property safe and from crime. Courts have found, this is something very important, courts has found landlords particularly responsible for crimes that have occurred in the property if they have not been provided adequate security. Now, this does not mean you need to put burglar bars on your windows, but you have to take into consideration that putting deadbolt locks, actual good locks on the doors to be able to provide the safety to make it harder for somebody again may be vital. Having the ability to have your home structured to where it can actually accept an alarm system could be vital. I'm not saying you actually have to go and set up ADT, but if you have the ability to have that offer for the tenant to make the choice is a different story. You've been shown that you've given them the opportunity, and it's up to them to take it from there. Number 5, do not discriminate against current or potential tenants. Well, it's just vital, and it is a very large definition to this, but in essence, what we recommend individuals to do is to be able to learn what the housing laws offer, and what you as a landlord are responsible for, and what the individual opportunist client, tenant, and or the client that you're renting to, what their rights are.
And Jason, here in regards to the 10 ways in landlords to avoid legal claims, one of our members, Aaron Robinson, asked, does renter's insurance or some other type of insurance also cover a third-party visitor for the tenant if they're injured, or for that visitor that occurs at, let's say, an amenity like a clubhouse or a pool?
So that's where the general liability comes into play. So the general liability or your home insurance has a section called personal liability. So if you yourself as an individual cause harm to a third party, it does not mean you have to be on presence. I could be golfing, hit the ball, hit somebody in the head, and they come back and sue me because of the fact that I ended up causing that damage to them. My personal liability would actually come into play with that. So as long as it's related to that, it would actually be extended to any third party that does not live on premises.
Okay, thank you, sir.
You're welcome. Number 6, utilizing care and consistency with business practices. Highly, highly recommend. If you are not an expert, outsource. And one of the biggest things is that we highly recommend is to make sure that you have contracts that are approved by the state, but also provided by individuals like real estate attorneys to be able to provide the leasing agreements or provide the contractual agreements that you have with third parties. It is vital and very important. Number 7 is to always make appropriate disclosure to tenants and prospective tenants. So including information about sex offenders that are living in the area. You as a homeowner, when you buy the property, I request that you ask the sellers not only about the property, but also from the information that is around the property. In today's world, you can literally go into an app and find the crime and or the murders and or the arsons that are within those areas. I highly recommend that you do that before you start investing to a property, because that's part of the due diligence, because it is going to be a sellable upsell for you if you are not in those particular areas or there's some distance from that. Very, very big thing there. Number 8 is to never violate a tenant's privacy. Well, that's just a black and white. It's in today's world with technology, people really can't hide from anything, and the ability to give somebody privacy and having you separate that is very, very important. Number 9 is follow all legal requirements, eviction rules. Super important. Just as much as you place somebody in and you might have done all of the due diligence, I can tell you, I typically have a saying that you are not the same person you were a year ago. Something typically changes. And sometimes those motivating factors cause people to do things that they previously probably wouldn't do. If by knowing the rules, it will empower you to be able to protect your investment, your asset, and making sure that you have a property that you can continue using. And number 10, basically allows always return the security deposit and provide documentation and repair. Document, document, document. In the world of litigation, people can sue you for anything, and the ability for you to be able to track, record, and be able to share that readily, easily for individuals to be able to be transparent not only gives you credibility as an investor, but it gives the ability for everybody to promote you and be able to share with you. So being able to share that is super vital. Now, getting into life insurance. When we get into life insurance, before I go into the topic of how to leverage life insurance as being in the option of being your own bank, I need you to understand that there's different types of life insurance policies. And then from that, why we focus within the areas of what we consider permanent insurance. So the first one that we'll talk about is term insurance. Then we'll go to permanent insurance, pre-need, and then we'll go to permanent insurance, which is where we're going to be living in that particular realm in the second part of the presentation. But first, what should I have? This is a diagram that kind of gives you a perspective that we work with investors specifically on life insurance. So if an individual investor is averaging around $25,000 a year in actual income coming to their home, what we do is we recommend that they get about a $620,000 life insurance policy for a 30-year-old, and it scales depending on their age. Okay. Now, depending upon their actual level of what they take home is dependent upon what we advise them to insure themselves, because you have to take into consideration, this is for lifetime earned income. So which means if you pass away, your spouse, your children, or anyone important to you has the ability to replace that income that they will not have because they are not in your business. It's no different than saying, I'm going to go and get into a partnership with someone who doesn't know what to do. They would run that company down. And for ours to be able to make sure that we protect the people that we leave behind, this is the parameters that we do. Now, one of the reasons that you may notice is that the number of the life insurance that we recommend starts up at a higher number and it decreases over time. It's specifically because typically with families, as the kids get older, they end up being self-sufficient. They have their own living, they make their own money, and your necessity for money isn't necessarily as great. So, term insurance. What is it? When we're talking about term insurance, it's really by definition, it is for a time period. There are policies out there that range from 5 years to all the way up to 30 years. There's two main things about term insurance that you need to know. It is the least expensive policy out there and available, but it's also the one that is the most profitable for the insurance companies. It's basically gambling. The insurance companies have rolled the dice and they've done their numbers, and their actuaries and their analysts have basically analyzed and saying term insurance is where we make most of the money. Why? Because people have sold it as buy term because you can invest the difference. The problem is probably a good 90% of people don't invest the difference because life gets in the way, situations gets in the way, and it's something that you want to be aware of. Then you get into the areas of something that has been around for I would say about 10 years or so, but is something that has taken a lot of traction within the last couple of years, especially with COVID. It's called pre-need insurance. It is an actual policy that is designed to pay for your funeral or your cremation. It is designed specifically to pay that. So what would happen is that this particular type of policy, you would actually go to a life insurance company like ourselves, and we would align you with a particular funeral home. We would find out exactly the total amount of budget you want to take care of for a funeral. And let's just say it happens to be $10,000. Here's the differentiations between a pre-need policy and a life insurance policy. The life insurance policy, you're typically paying for 30 years with a term. With a permanent policy, you're paying for the rest of your life. With a pre-need policy, you're only paying either one payment, 3-year payment, 5-year payment, or up to 10 years. But if you happen to pass away, there's a life insurance policy that is connected to it that pays the difference so that the beneficiaries never have to worry about it, and you have the ability to use it. This is the alternative for someone that says, you know what, I am ill, I have diabetes, I have cancer, I have serious illnesses that my life insurance policy wasn't able to be approved. This is the alternative because they have a broad form and they're able to approve probably about 95% of people. Why do I share the difference between these? It's because of the fact that sometimes people connect one to the other when they have no comparison. The areas of permanent insurance is the world that we're going to be talking about. There are realistically about 4 different individual policies that are out there in the market. There is a whole life, the universal life, and then there's variable life and variable universal life. I'm not going to get into great details about all of them because it's irrelevant for this particular topic, but what you definitely need to know is the fact that on the universal life, if you stop or reduce the premium that are being saved to accumulate getting into the policy may lapse because the utilization of funds from the savings account, what they call cash value, ends up being depleted. And over time, it may not be able to support the life insurance policy because you're not properly funding it. When you hear the word variable, all that basically means is there's a specialization, a license that is allowing an individual to purchase a life policy that's connected to a mutual fund or to connect it directly into the market.
And
yes.
Sorry, Jason. Quick question came in here just so we don't go off topic again. Is what happens if the funeral company goes out of business?
Great question. So with pre-need, it is a policy that is connected to one particular funeral home, but it is not locked in by the funeral home. these policies are basically national. So even if you decide to move from Texas to Oklahoma, as long as because you're taking basically a life insurance policy and giving it to the funeral home in Oklahoma and says, hey, I have a policy for $10,000. What am I willing? This is what I purchased. And then what you would do with that other funeral home is pay the difference, if there is a difference. So with respects to whole life, as it indicates here, it says, this is the most common type of permanent insurance policy. It offers a death benefit along with the savings account. If you pick this type of life insurance policy, you are agreeing to pay a certain amount in premium on a regular basis for a specific death benefit. The savings element would grow based upon the individual's dividends that the company pays to you. Why? Because the whole life policies are deemed that as the insurance company makes money and has profits, they end up sharing that with the individual policyholders, which is very, very important. And we'll show that a little bit later. Now, here's the part that I love. And a lot of people may say is, well, how can you be your own bank with life insurance? Well, it is completely 100% based on perspective. I can tell you that when I go into a real estate investment opportunity, this is the way that I've been able to build the ability to invest while being able to capitalize on several things. Number one. Yes, sir.
And Jason, this question came to us earlier. Obviously, I was waiting for this part of the segment. It's from Rick Bressler. He's one of our private capital investors.
Yeah.
It says, discuss the pros and cons of be your own bank versus having an annuity. Is that something that would be part of the discussion? And the other one is discuss the pros and cons of term insurance versus invest the difference and being a bank.
Yeah.
Okay.
All right. So I'll start with the term and be your own bank with whole life. Well, it's not that the fact that term insurance is bad. It's the fact that human nature, the majority of people don't have the discipline to invest the difference. That's the main difference. Could you do this with the whole life? What you do with whole life versus term? The answer is you could, but it's going to take a lot of insurance to supplement it because the rate of return that you end up getting on how this is structured, the way we structure this, is very, very different. So the term insurance, there's really no correlation. It doesn't work in the model. From an annuity perspective, an annuity, now one, I personally am not an expert in annuities, but what I can tell you is on an annuity, typically there are stipulations, regulations, fees that you have to pay for pulling out money. And sometimes there's even whole times that you have to hold the money for a period of time there before you can actually withdraw it. And there's penalties for that. In the type of structure that the way we design our policies with the investors we work with, we eliminate all of that. That's probably one of the biggest factors there. It doesn't mean that annuities, you couldn't use it. And it doesn't mean, and you can't necessarily borrow it, but if you borrow it, you're with annuity, you're typically going to be paying a fee or paying a penalty in doing so.
Okay, thank you.
All right, so why life insurance works. Here are the top 4 things before we dive into the actual methodology in the process. Number 1 is because it's a guaranteed liquidity. Guaranteed access to the equity whenever emergency or investment opportunities present themselves. No age restriction applies, which is super important. Growth, safety growth, controls the growth without market losses. Your equity continues to compound on your behalf, even when borrowing against for outstanding investment opportunities. And I'll be very specific here on what this means. If you have $100,000 in an account and you borrow it from your life insurance, you will still earn interest on the money as if it was there because you're borrowing it from yourself. The insurance policies will pay an interest on the money there. When you pay it back, there is no payback. What happens if you don't pay it back, they deduct it from the face amount. So the beneficiaries will get the difference. But if you do pay it back, what you end up doing is you replenish your bank account to be able to utilize it for something in the future. The tax incentives, build in the ability for tax shelter growth, tax exemption distribution, tax-free death benefit, and quite frankly, the question is, as it states there on the screen, is do you think that taxes could be raised in the future? And the answer is yes.
Mm-hmm.
Last but not least, the additional benefit. Well, you have the shield. The policies are designed to be able to protect you against death, disability, chronic illness. So you may get some specific things like cancer. Those are things that the policy could pay towards and against. But most important is this: your savings account, your annuity, your IRA. If I were to sue you because you did something that caused a liability, as long as I won, have the access to all of those, including and not limited to the investment property that you purchased. If you have equity in that property, the judge could put a lien on that property. I can put a lien on the annuities. I can put a lien on anything and or force you to deplete that. Life insurance is one of the only vehicles out there that gives you the ability to protect you against lawsuits. And that is one of the strongest things that I would say with respects to the being your own bank concept. All right. Banks profit exponentially off of almost everyone in America. Either they are lending you money to buy cars, to buy real estate, business inventory, and or equipment. Or you're parked your cash safely inside their holding tanks so that they can hopefully, you won't ever have to need any of their money for their loans. Meanwhile, they're loaning out every single dollar for your savings multiplied different times, so that they are able to profit handsomely, and then you're left with peanuts, which means they're borrowing your money so they can borrow it for somebody else. They're charging great interest, making a great return, while you're making very little off of them. Either way, they win. My goal is to show you that how to be profitable by running those exact same the cash flow through your own private banking unit to build two assets at once and to get you more money where you're wearing multiple hats. In order to do this, I wanted to explain to you that my job is to dissect both of the ways of the way that banks profit today, and specifically within the areas in the realm of real estate. So keep in mind that through the exact same model you can use by business owners investing in their business, or by physically responsible consumers with their major purchases in life. Let's first look at the traditional banking finance for ongoing real estate investing. You eventually borrow against the property itself to qualify for the bulk of the capital necessary to acquire. And then from that, you then make the ongoing structured principal and interest payments to pay off the loan and get yourself back to even. Eventually, though, you'll want to invest into another property. So you again have to prove not only your credit worthiness, but you also have to have the feasibility of the project that you want the money for. So as long as you continue to make steady payments and diligence on the payback of the bank according to the terms, you should be able to hopefully continue financing your real estate empire by growing your assets over time. But be very careful about the fact that there is no guarantee that the banks will continue to make this liquidity available to you. If there is a soft market like there is today, or if for whatever reason, the banks don't necessarily share the same vision as your project, as your strategic plan in your business, they can basically pull the plug of your financing at any time. This is no more, and also there's other individuals that would like to play with their own cash. So you don't have to necessarily be the bank. So let's face it, some people simply hate the concept of borrowing money. Totally get it. But even if you help them exponentially acquire assets by utilizing financing through the banking system, they won't just feel better paying cash for every single property, but they buy and not being able to be on the hook. That is a big feeling for them. Well, in order for you to be able to have that, you want to be able to have the banking capital to be able to earn the interest over time. Well, if you don't have that interest, well, ultimately then, is it really a profit margin, and are you doing good business? Then once you acquire the first property, you own it free and clear. And then you don't own anybody any money, which is great. And yet, even though that you don't need to pay the debt service to a bank for the future of their money, if you want to buy a property in the future, you still have to continue to making ongoing payments into their own account, earning very little to no interest. That way you have enough cash in the future to purchase that next property free and clear. Because of this, the payment structure that you have, nearly identical whether you pay cash outright or even single property, or you finance them 100% using bank loans. Now some of you may be saying, well, wait, if I buy this in cash, at least I don't have to pay interest to the bank and I don't owe anybody money. And that's true. But remember that you are passing up earnings and reasonable interest rate by owning your own capital, by keeping it safe and accessible inside their coffers. In fact, your actually vulnerability gains by the multiplier. You have the ability to have blocks of liquid assets in between every single property that you purchase. Even if the interest rates go up considerably in the future, you wouldn't be able to take full advantage of it, because as soon as you get into your account to the point of critical mass, you kill the compound curve every single time because you withdraw the cash to buy another property. And it doesn't need to be that way. For the rest of this presentation, I'm going to change my focus, and I'm going to go show you how to create money multiplier by affecting your own bank by keeping your liquid reserves safely and continuously compounding for you, even though you have them doing double duty elsewhere. You see, in the perfect world, you save up the asset one time, and then you go ahead and compound into the future. What's so powerful about compounding is that you not only earn interest on your principal, but you pretty soon earn interest on the interest through the principal already earned. It creates this wonderful snowball effect, which over time will start compounding and building, and you'll see really the ability to build wealth. This is why the curve on the right is a lot steeper than the one on the left. In fact, when I ask clients, which side of the curve would you rather have? Everybody automatically goes, I want to be on the right. But you don't get that without actually putting the time in building that curve on the left. You say it's just time value of money. Keeping assets consistently compounding over time is genuinely the key. Unfortunately though, these purchases do need to be made. Every time they are, it just resets our compounding curve to the very beginning, killing our chance of earning and getting to the far right hand side of the curve. That is, unless there's a way to be contractually borrow against our assets at any time for any reason. You can do this, and then the red line comes down, indicating that there's a lien against your asset base. But notice that the entire asset base continues to compound up that green curve. As you pay down the lien against the asset, we actually end up with in a higher place in line each and every time. Why? Because you're borrowing against your policy. When your asset sells, you put the money back, but then guess what? You're putting back more money, your interest rate ends up growing, and the more money you have, well, obviously it's an indicator upon your ROI. That's really the biggest compounding component of this strategy. In fact, the entire asset base continues to compound in your favor, in spite of having used some of it through the purchase process. Now it helps for you to be able to have this compounding strategy to be able to worry about or not worry about the tax incentive that are involved, the volatility of the market. Because of the way that these policies are structured, you're not having to be deemed to what happens in the market. And that is very powerful, and it works definitely in your favor. All right. So now, keeping in mind that the cash flow and payment structure we've used is an apples to apples comparison with someone paying in cash. In fact, that you don't have the entire asset base compounding for you when you withdraw the cash from an account to purchase or to make a purchase. You need the astronomical rate of return to make it work and to overcome the tax due that is simply just pale to comparison of how effective banking strategies can be. So the question really is do you want to be Sam the saver, or you want to be Benjamin the banker? And this is in the structure, you have the ability to do so. Now, one of the things that you need to be aware of is that every individual case is individual, individually structured for everybody, because not everybody comes from the same background, the same cloth. And sometimes the necessities or the availabilities come from there. So I do want to make a disclosure that when we're dealing with one of our investors, we are actively looking for several elements, not only your health status, your age, your occupation, your abilities. And this is not something that we just basically pull off the shelf and say, hey, it's a cookie cutter, we're just going to give you this because it's a standardized. It is something very specialized that we do for each one of the investors. And the reason we do this is because we align ourselves with your strategic goal between the first year to the next 10 years, so that in essence, you have the ability to compound and be your own bank by leveraging life insurance. Here's an actual case study. So we have a 45-year-old male, non-nicotine, purchased a life insurance for $1 million. Here's basically what we ended up doing. We ended up basically looking at these individual companies here, and we looked at the 10-year, it's a 10-year guarantee. So basically this individual client was paying a policy payment for 10 years at, if you notice here, the graph, it says the lowest premium is in the light blue, the highest premiums are in the dark blue. So the highest that this individual at 45 years old was paying about $42,390 annually, which comes out to be about $3,500 a month. Or at the low end, through National Life, we had the ability to create the scenario where they're paying $36,070 on an annual basis, and which comes out to be about $3,000. Why is this important? Why? Because of the fact that if your model is structured to where the revenues come in and you have the ability to support, and it doesn't have to be $3,000. It could be even less. It really could be catered to you. You have the ability to leverage life insurance to get not only the face value to protect things that are important to you, because if you're no longer here, but it gives you the ability to put money aside that you're building interest on, putting it into a savings account that ultimately will pay you hefty down the road. But when the time comes that you have enough cash value in your account, you now have the ability to withdraw it to buy into an investment and buy it in cash. So if you are a private lender, you could do the exact same thing by pulling the money out, your policy as it deems in this particular this chart, your death benefit. If you were to pass away, the IRR, the internal rate of return for a 20-year policy or 20-year amortization, or a 30-year, look at the difference. You get a return of 9.13 versus a 6.54. But here's the important part. You're making on the money you're putting into this policy 4.26%. At a 30-year internal rate of return, 4.72. And I can tell you that it does vary over time. And probably the highest I've seen it is probably up in the 7s. The lowest I've seen it is about close to right below 3%. So you may ask, the question is, why do I do this? And it's very important to me that our company is based out about a things, but our number one focus is our purpose. And as it states there, it says, it's to be of service to family, faith, and without integrity, nothing works. You may notice if you get a chance to look me up, we have been very privileged by several things to be able to do what we do. We own an insurance company called Jimenez Insurance Agency, which is our property casualty firm. And we also own the IMD Financial Services. But by the end of December 31st and 1st of January, we're actually in the process of merging both of those individuals because we have expanded into several different markets. So for that, I appreciate your time.
All right, Jason. Thank you so much for your information, sir. And obviously this is a lot of information and it could be a lot of new topics for a lot of people. That's why, you know, it's great that people can reach out to you and definitely get to pick your brain a little bit more, because in every different level of the real estate business, these things are going to come. You know, you're going to have questions. And if you don't take the time to take advantage of speaking to somebody like you, you know, you don't want to miss that boat. And it could be a 5-minute conversation that turns into eventually, you know, going on a plan of wealth, in which you're talking about right here. And so we truly, truly thank you for the time and that you spent on that. So now, guys, if you guys have questions, feel free to, we'll send them over here to Jason. Let's see here. Jason says, are the payments for the life insurance tax deductible?
So they could be, but they're not recommended because then your benefit, your death benefit ends up being taxable.
Okay.
Because the tax bit, by not deducting it up front, what ends up happening is you end up building the ability where the death benefit, when and if you ever pass away, ends up being passed through to your beneficiaries tax-free.
Excellent. Excellent. If you guys have any more questions, greatly appreciated there. Jason, we've had some people are chiming in on the chat. Said Tiffany Godley said, I learned something new. Thank you so much for sharing your knowledge, Jason. I know Ivan P, a little while ago, he just wrote in there, wow, a big wow, which I think he's really enjoying the information. Guys, these types of sessions that we do and that StrataVentures brings you is because we work with people that are here to earn their business by educating you and by most of all letting you know how their business works and how you can benefit also from that. So we're opening this still up for questions. Let's see here.
Here's another thing, if I may, Diego.
Sure, go ahead.
The other question comes in. One of the things that we talk about with investors is you buy a property and then typically, and let's just say it's a flip, right? You buy a property, you go and get it rehab, and then you end up getting it staged and then they're putting it back in the market. I want you to realize that the moment you put a real estate sign in front of your yard, what is it doing? It's promoting, come see me, come to me. I am highly recommending you to be able to put what's considered a rider on the top or the bottom of that sign and getting your real estate agent and or whoever's representing you to put by appointment only. Why? Because that one statement allows you to make sure that people that just don't show up to your home and walk onto your property and then trip and fall because there was a hole or there was something there that they ended up hurting themselves because they did not have permission. That just one statement allows you to take control of that liability. So that's something I definitely want to share.
All right, let's see here. We have a gentleman, Juan Antonio Ruiz, asked for your contact information. And I think, Enid, you were posting that here. Give me 1 second. Let me get that out to you here.
I appreciate that. Thank you.
Okay, this is going out to all attendees. All right, there you go. All right, Jason. Usually, when we have these sessions, and the same thing when I'm speaking to people and I ask for questions, if you don't hear anything, I usually call it hitting the bullseye, which is a good thing. And again, really appreciate the information. To everybody that is wanting to get a copy of this webinar here, I'm going to go ahead and stop the sharing here, Jason, real quick for you. That's wanting to get a copy of this webinar, then we're going to go ahead and see if you want to go ahead and subscribe to the StrataVentures social media YouTube pages. We are going to put Jason this webinar on our YouTube page, and then also send you a list of all the people that attended today. So for those of you that want to know a little bit more about StrataVentures, just make sure you go to investorrealestatetraining.com, because we have these great workshops that we have all the time in which for you to get to know a little bit more about StrataVentures and what we do. And then also, please feel free to follow us with using this QR code on your phones. There's a lot of great information there and the ability to get to know us a little bit more one-on-one. And let's see here. We have another question. Robbie Hernandez, I would like to get a copy of this webinar, please. Feel free to go ahead, Robbie, and subscribe, and we'll be happy to get that information out to you. We do like to keep people in contact with every single one of our vendors, and we have noticed that if you doing it by subscribing, we're putting all the information into our social media platforms, which in turn then notifies you when that's done. So Jason, do you have any closing comments that you want to do before we shut this down and send everybody home to their families?
What I would end by saying is this, it does not matter if it's your first home or if it's your 50th home. Understand that buying a property with the intention of making money means that you've created a business. And there's a differentiation of understanding that creating a business deems and it's correlated to having responsibilities. And those responsibilities are about protecting everything that you mean so much to you. My job, if I'm so privileged in doing so, is to be able to ensure the things that you protect and that are vital to you. And I appreciated the opportunity to talk to you all. And I wish you all and bless you all for the rest of the year.
Absolutely. And general liability in this business, general liability. All right, buddy. Appreciate your time, sir. Have a great evening. And to everybody that has joined us, a big thank you from myself and the StratoVenture staff. Again, remember every Monday from 6:30 to 7:30 Central. We look forward to seeing you guys again. Keep an eye out again. Subscribe to the SVI social media. We're constantly sending out more updates and new things that are happening in the StratoVentures world. Good evening, everybody. Bye, Jason.
Bye, guys. Thank you.
Good evening, everyone.